All right, guys, Lowe's just reported they were expected to make $3.44 per share. They made $3.77 per share. They're expected to do $21.6 billion in revenue. They did $22.3 billion in revenue, and they're currently up 2.77% right now in the market, $5.63. It is flossin'. Their all-time high, December 13th, 2021, of $263 a share. So they're still 20% below their all-time high, right?
Yeah.
During COVID, what did they get to at COVID? Let's look at the COVID numbers. How low did they get? How low did it go? How
70,
low? $670 roughly?
72.50.
No, I see 68 right here.
Oh, damn. Okay.
Yeah, 69.87.
Okay.
All right, so guys, a couple of parameters on Lowe's. Let's take a look before Mo reads us the actual press release. $126 billion market cap. That means if you bought every share outstanding, it would cost you $126 billion. The enterprise value is $182 billion. That's if you took the company with all its debt and all its net cash. So the difference here is essentially the net debt. Okay, but it's retail. It's got a lot of leases, and I'm sure that's a big reason why the debt is there. So we can actually go check that out on the balance sheet and see how much is leases. Long-term capital lease obligations, $36 billion. So yeah, that's $36 billion of the almost $60 billion there, $58 billion. All right, decent dividend, 2%. And their dividend eats up $2.5 billion of their free cash flow. Now, the thing we like to look for, remember, dividends aren't always secure. We want to compare it to their free cash flow. Last year, they did $5.85 billion. The last 5-year average is 6. We want to see it under 50%, and it is. 2.5 is definitely under the $6 billion average, and definitely under last year's 5.85. Mo, what are you finding?
So, total sales for the quarter were $22.3 billion. Comparable sales, however, decreased 4.3%, driven by lumber deflation. The same unfavorable weather conditions. Pull up the lumber chart.
Home Depot,
yeah,
talked about.
Yep, exactly.
So let's explain that real quick. Mo, do you mind explaining that real quick?
The lumber stuff?
Yeah.
Yeah. So, guys.
And the same store comparable sales.
Yeah. So, just look at what lumber costs did. I remember when people were saying lumber costs just spiked and things got very expensive. Pull up Pulse chart real quick.
This is year to date. It hit. By the way, the all-time high is recently it hit freaking $1,500.
It was insane.
It hit a high here recently of $524 back in January, and now it's at $344.
Yeah.
So they're sitting there saying, hey, we sell a lot of lumber, and when lumber prices are down 30%, 40%,
we're going to get hit.
We're going to get hit on revenue. Yep. And their same store sales, comparable sales, decreased 4.3%. What that means, if you're new, is they compare stores that have been open 12 or 18 months or more and see how their sales have done. Okay? That's an important aspect for retail. It's always what I tell people to look at when it comes to retail locations. All right? Now, if you're new to the class, if you're new to this channel, please subscribe, because what we like to do is approach every investment in the long run. We don't look at earnings results as a way of going, yes, we were right. Every quarter is going to be different. Some people are going to miss, some people are going to beat. Our goal is to find opportunities, and we hope the companies miss because it drives down prices of. Go look at the history of any company you love. They don't beat every single time, and they shouldn't.
No.
So what do you see?
There's a problem.
Oh, wow, look at that.
Yeah, so they repurchased approximately 10.6 million shares for $2.1 billion. Can't say I love that. Just taking a quick peek at their PEs. Yeah.
So guys, what that means is we like when companies buy back shares as long as they're cheap shares. And this PE doesn't seem very cheap. Could it be? Sure, because look at this return on invested capital. Mo, do you see this?
Whoa.
51%.
Whoa.
That means, guys, when they have an opportunity to invest, they get a great return on the money that's invested in the business. The market average is 10%. Let's put it this way. Apple is 37%. They're at 51%. Now, in an ideal world, they'd be able to invest $1 billion, $2 billion, $3 billion a year at 50% returns. But that doesn't really happen, especially with big companies. But what it does mean is it leaves extra cash flow to be given out to investors through dividends, buying back shares as long as they're cheap. Mm-hmm. All right, what else do you see, Mo?
So looking, and this is outlook of the full year of 2023. Total sales of approximately $87 to $89 billion. Previously, meaning 2022, was $88 to $90 billion. But 2022 was a 53-week year, so maybe that throws it off a little bit.
But didn't they? I think they kind of guided a little bit lower than before.
They did. So comparable store sales are looking to be down 2 to 4% as compared to the year prior, which was down 2%.
Flat to down.
Flat to down. Now, I find this interesting. They blame the comparable store sales on lumber costs. So lumber costs are where they are. Can you pull that chart up one more time?
Yeah.
They seem pretty below average, actually.
Well, that's for the year. That's only for the year.
Okay,
Let's go to max.
Let me see this. Okay.
So
they still see comparable.
But it's only going back to 2013.
Well, they still see comparable sales coming down, and lumber prices are, call it average, maybe a little bit more than average.
Yeah, and part of that could be a big surge in home improvement lately. I don't know, but the point is, guys, if you like Lowe's, and Mo, do you think Lowe's will be around for the next 20 years?
Absolutely.
I'd be floored if they weren't.
I'd be shocked.
I'd be absolutely floored. Guys, I don't use my hands on anything. I like going to Lowe's. I was happy recently because I took the inhibitor out of the water restrictor out of my shower head. I'm telling everybody I'm a plumber, basically. All I did was take this little black ring out, and it made my shower head a freaking jet engine. It's awesome. It's the fire hose out there. Literally, I went from you could see my shower head would literally arc like this to now it's literally, and my curtain comes in on my shower. I can't wait to move houses.
And now you're explaining to me how to do it because you're a plumber.
Yeah,
so you're like, you can do this.
I need a tool belt. Lisa's always like, get your tool belt out.
And a shirt that says Paul.
Exactly.
One of those shirts.
So we're looking for an opportunity, and we hope negative news comes up because we don't think Lowe's is going away. Yeah. We just want cheaper shares, right? Yeah. You should root for a lower price. You should root for temporary bad news on companies you love.
Look at those shares outstanding.
Down 21%. They're just wasting money.
I know, it's a total waste of money.
So this is our 8 pillars, guys. Now remember, if you have our software, you can do a custom 8 pillars. Up to 12 different pillars, and there's literally 4 quadrillion different variations you can do. But in ours, a high PE, a low price of free cash flow, So the price of free cash flow is lower than the PE, which we'd like to see. Mm-hmm. But long-term liabilities, I'm not worried about. Nope. Might as well make this. Let me make this green.
Green check.
Might as well make this a green check mark.
Yeah.
Because I'm not worried at all about. I'm not at all worried about this long term. So really, it's only the PE ratio. Yep. That's it. And the 5-year PE of 23, listen, it's a strong brand. Maybe that's okay. But I want people buying back shares when it's obvious they need to buy back shares.
This is obvious they should probably not be buying
Well,
back
we don't
shares.
know that yet. So let's look at analysts and see what they're saying.
All right, let's see.
Oh, wow. Big growth in, I'm actually surprised by that. Big growth in EPS.
Maybe it's because of that 50% return on invested capital.
Yeah. Man, look at that. Big growth in EPS. I'm actually surprised by this. So right now, the company is selling for about 10 times 2028's earnings. Don't look at that and say, oh, it's a 10 PE. Please don't. You're going to get yourself in trouble doing that. But look at revenue. Revenue is expected to fall this year, 9%, which makes sense with same-store sales. It's basically going to be flat for the next 5 years, 6 years. Yeah. That's pretty interesting, isn't it, Mo?
Well, I mean, I would see declining revenue. So on average, I look at this.
But for this PE,
yeah.
I mean, granted, they're driving their EPS up.
Correct.
Guys,
Correct.
It's great that they're driving that analysts think they're going to drive EPS up with flat earnings, with flat revenue growth. I like that. But remember, and that's what I like about their gross margin. Their gross margin, gross profit margin, that can't be right. 33%, that is right. 33%. And bottom line, average 5 years is 6.1%, 4.4 over the last year. Now let's see where the 10-year profit margin is, because that's going to be really... Okay, so maybe the last 5 years were a fluke, because the last 10 years is 5.5% profit margin. But I like this. The free cash flow margin is higher than the profit margin, and free cash flow is really what drives the business.
The revenue growth was insane from 2020 to 21. I mean, if just look back to 2014 and go every year. So you had, let's call it 3 billion, 4 billion, 6 billion, 3 billion, 2 billion, 3 billion, 20 billion. Now it's sustained up there. They've grown about $1 billion a year, but at what point does that just start to trickle off?
Yeah, you're right. So... Guys,
that's probably what they're seeing from the analysts from the revenue perspective.
Well, I mean, guys, whenever there's a big jump in revenue on anything, I had a member of the community reach out to me about Zim the other day, a shipping company. I'm like, listen, shipping went from 5,000 a container from China for us to 25,000 a container because of all the constraints and demand. That's not a sustainable. You can't base your valuation based on the best year that was a one-time fluke.
Right.
Is this going to be declining revenue forever? I don't know. Remember, inflation is going to help these, because guess what? All of this income, all this revenue that comes in is basically the cost of things. So if our costs go up with inflation, that revenue is going to go up, right? And what's going to happen when revenue goes up? Profit goes up. And when you have a decent gross margin and a decent bottom line margin, it helps you, okay? So let's go back to the Stock Analyzer tool. I'm going to do a 20-year analysis here. Guys, our Stock Analyzer tool was the most popular part of our website, used 1.3 million times last year by the thousands and thousands of people in our community. This is alone probably worth hundreds of dollars, literally a month, because you look at it going, it gives you the guidance on making your assumptions about investment and telling you what you need to pay in order to get the return that you desire at the very bottom. Now, it doesn't include the balance sheet, but this alone, along with all of our other tools in our software, you can try it out. $7 for 7 days, $1 per day. Try it out. No brainer. We literally go to everythingmoney.com. It's no brainer, $1 per day. If you can't do that, then I don't know how serious you are about investing. So I'm going to do a 20-year analysis. Mo's going to do 10. We're going to do I'm probably going to talk through it a little bit, or should we pause the video? Okay, I'm going to keep talking through the video and my assumptions. So like revenue growth, it's going to be a little bit lower, but 20 years though. Okay, so I'm going to do that. If we have higher inflation, open more stores. Profit margin. Okay, free cash flow margin. You know, these are very tight numbers, Mo. Like, as you can see, their performance is pretty consistent, which I love about companies. Yep. Now, PE. The current PE is around 30. All right, so it's a good brand. It's a good brand, so I think that deserves a premium over the market average of 15. Now, the question is, you know what? Actually, I'm going to do this. 15, 17.5. I'm going to do 10, 11.5, and 13.
Okay, I think that's fair. So,
guys, my revenue assumptions, remember, we do a low, middle, and high. And depending on how different they are, it's going to be a wide range as you go out further in the future. So my ranges could be very, very different because I'm 20 years in the future. The further and further you go out, the wider and wider the range gets. Mo is doing 10 years. Mo, what did you do for your revenue growth numbers?
I did 1, 3, and 5.
All right, I did 2.5, 5, and 7.5. I went out 20 years.
7.5 is crushing.
Yeah, but if they open more locations, go international, et cetera, is that possible? Mm-hmm. Sure, but that's over 4x their revenue in the next 20 years. That's a lot. Yep. Over 4x, could be 5x. Mm-hmm. Profit margin.
I did 5, 6, and 7.
I did 5, 5.5, and 6.
Okay.
Because I looked at their 10-year being 5.5. I'm like, okay.
All right.
What did you free cash flow?
I did 6, 6.5, and 7.
You know, I'm going to change mine. You did this. You did that. I'm going to do 6.5, 7, 7.5.
Okay.
PE.
16, 18, and 20.
I did that originally.
Yeah.
But I changed mine to 15, 17.5, and 20. And the reason I did that is there's still Home Depot. There's still the issue of internet. Like, I wonder if, I don't know. I just felt 16 was a little aggressive for me. And you do the same thing for your price of free cash flow?
Yes.
Now, what'd you do for your desired return?
I did 10, 12, and 14 because I think my assumptions on the high side are high.
And your low side was low.
My low side was low. Yep.
So guys, I did 10, 11.5, and 13 because I went 20 years out, so I do a little bit lower on the middle. But guys, basically this is your margin of safety. The higher your assumptions, the higher your desired return, because the more you return, the less price you pay. So the more you give yourself, the more premium, the more desired return you give yourself, it's the more margin of safety, the less you're paying for the company. If I pay $200 for this phone, I make a lot more money than if I pay $500 for this phone, right? Mm-hmm. No difference. The more money you pay, the less return you get. So I hit the analyze button. The stock's currently at 209. And here are my prices. I have a low of 110 to 145, a high of 190 to 234, and a mid price of 144 to 184 with on my watch list at 170. Mo, what'd you get?
I have 105 to 125 on the low, 170 on the high end, 136 to 147 in the middle, and my watch list is 175.
All right, guys, that's where we stand. It's at my watch list at 170. If you like the channel, subscribe, but everythingmoney.com, $1 per day to try out the software. Thank you very much for your time.